Candlestick Zen. Sometimes you want to lose. You can win almost every trade and still lose all your money. You do not want a Pyrrhic victory. It is better to lose some battles and win the war. The majority of traders at the beginning of their career are obsessed about winning every time. They think they must make profit with their every trade. That is simply not the case. Even if we disregard the fact that it is impossible to win every time, it is not necessary. And in most cases, it is simply a waste of time trying to do something that is not important. You just need to win enough times that you can make money trading. And how many times is enough? That depends on the strategy. Here is how it works. You test your strategy with a clear set of rules and a specific risk-to-reward ratio. If you do not know what risk-to-reward ratio is, watch the previous video called Risk-to-Reward Ratio, Everything You Need to Know. Understanding the risk-to-reward ratio is crucial to understanding the profitability in trading. You cannot understand the winning rate of your strategy if you do not understand RR ratio first. Once you have your strategy set with clear rules and risk-to-reward ratio, you test it. After testing it and making at least 100 test trades, you will have your winning rate. Always do tests on a demo account before you test trading with the real money. Winning rate is simply the number of winning trades compared to the total number of trades. Let's say that your winning rate is 50%. That means that out of 100 trades you made, 50 of them were the winning ones, and 50 of them were losing trades. And now is the time you need to include your risk-to-reward ratio to understand the results. I will ignore the compounding effect to make the calculation simple. 50% winning rate implies that if your risk-to-reward ratio is 1:1, you're at break-even. If you have 1:1 RR ratio and 50% winning rate, you will lose $1.50 times and you will earn $1.50 times. That means you're not making any money and you're not losing money either. If you want to make money with that strategy, you need RR ratio of at least 1 to something greater than 1. This is without compounding effect, meaning that you never increase the risk per trade in dollars. To make money with that winning rate, you could have 1 to 1.5 RR, for example. If your risk-to-reward ratio is lower than 1:1, with this winning rate, you will lose money. I do not even need to see the results of your test trading to know this. If you tell me that you have 50% winning rate and 1 to 0.9 RR ratio, I know you will lose money. And if you tell me that you have 50% winning rate and 1 to 1.1 RR, I know you will make money. If you have that kind of strategy, congratulations, you are one of the lucky ones. Now you only need to work on scaling the strategy and diversification of risk to make a living of it. If you do not have profitable winning rate and RR ratio combo, you have to work on it. Good news is that this is one of the easiest things to work on in trading. Easiest meaning that there aren't any doubts what you must do. You simply have to change your risk-to-reward ratio rule and retest the strategy again. And that is the bad news. Every time you change your risk-to-reward ratio, you will need to retest everything. You will need to make at least 100 new test trades to see what the new winning rate is. In this example, you know that you need a higher RR ratio to earn with this strategy. So you change it to 1 to 1.1, for example, or 1 to 1.5 if you want a bigger picture, and so on. With a 50% winning rate, you need at least 1 to something greater than 1 to be profitable. Easiest thing you can do is to move your take profit level a bit further away. If you do not know what take profit is, watch the video. Do you need to target the optimal moment to take profit? After making changes and retesting the strategy, you will get your results. What you will see is that your winning rate has decreased. Every time you increase your RR ratio, you will have a lower winning rate. Let's say that now your winning rate is 40%. 40 out of 100 test trades you made are winners, others are losers. If your RR ratio is 1 to 1.5, you're at break-even. That is, if you always risk the same dollar amount per trade. With 1 to 1.5 RR ratio, you make $1.5 for each dollar invested every time you're right. 40 times $1.5 is $60. That is your profit. 60 times $1 is $60. That is your loss. Again, you're not earning money, but not losing either. If you had the same 40% winning rate, but with 1 to 1.1 RR ratio, you're losing money. Because 40 times $1.1 is $44. That is your profit. 60 times $1 is $60. That is your loss. You will lose 60 minus 44, which is $16 per every $100 traded. That is 16 cents per dollar. If you invest $100 million, you will lose 16 millions with the same strategy on average. If you have 99% winning rate and 1 to million RR ratio, 99 times out of 100, you will win $1, and 1 time you will lose $1 million, which makes a total loss of $999,901. You see how you can win almost every trade and still lose a lot of money. On the other hand, if you have 10% winning rate with 1 to 20 RR ratio, every 100 trades you make with $1 at stake, on average you will lose $90. But you will also make 10 times $20, which is $200. That means that with 10% winning rate and 1 to 20 risk to reward ratio, you will make on average $1.10 per dollar invested. With $100 investment and trading once per day, with compounding effect, how long would it take you to make profit of $1 million? What do you think? About 100 days. Yes, 100 days to make $1 million with an investment of just $100. And all that using a strategy with 10% winning rate. Now you see how winning rate on its own does not matter. What is important is to have a profitable relation between the winning rate and risk to reward ratio. Sometimes you want to lose more trades to make more money when you're right. As long as you're losing small battles, but you're winning the big ones, you're going to win the war. You do not want a Pyrrhic victory. Candlestick Zen.